All right, get ready because today we're going deep on a classic investing book, Security Analysis by Benjamin Graham and David Dodd. Now, I know you might be thinking, it's 1934. Really, can a book that old actually help me in today's market? But trust me, this one's worth all the hype. You're trying to find those hidden gems, right? Those undervalued stocks. Well, Graham and Dodd. They basically wrote the book on value investing. And their ideas, they're even more relevant now with all the crazy market swings we've been seeing.
You've definitely got me interested. What is it about this book that makes it so timeless?
Well, they start off right away with a super fundamental question. What's the difference between investing and speculating? And they're very clear about it. A real investment. It means doing your homework. You analyze a company inside and out. You want safety of principle, and you want a good return. Anything less than that, that's speculation.
It's interesting how they connect that idea straight to the price. Like, you could be looking at a great company, but if you pay too much, it's not investing anymore. It's just gambling.
Exactly. Just imagine buying Apple stock back in 1999 when it was trading for, get this, less than $1. That's what they mean by looking at the price. Compared to how good the company is, even the best stock can be a bad investment if you buy at the wrong price.
That brings us to one of the core ideas of value investing, intrinsic value. It's not just about what the balance sheet says today. It's about how much a business can really earn in the future.
So intrinsic value, it's like what a company is really worth. To someone who wants to own it for the long haul, right? It's all about the cash flow it can generate down the line.
Precisely. Think of it this way. You're not buying just a stock. You're buying a piece of a business. And just like you wouldn't overpay for a used car that's about to break down, you don't want to overpay for a business that's going to struggle.
Makes sense. So value investors, they're looking for stocks that are trading at a discount to their intrinsic value. They want that margin of safety, like a buffer, in case something unexpected happens. But how do we actually figure out this intrinsic value thing?
Well, Graham and Dodd, they really dive deep into analyzing a company's income statement to see how much it can really earn.
Okay, so we need to be like detectives, looking for clues in the financial statements to see if maybe a company is, trying to make their earnings look better than they really are. Can you give me an example of that?
Absolutely. Remember back in 2017 when General Electric had to restate their earnings? For a bunch of years, they were basically booking revenue too early from these long-term service contracts, so it made their profits look way higher in the short term. That's exactly the kind of stuff Graham and Dodd warn us about.
So it's like, yes, they're giving us this toolkit to take apart those financial statements.
Yeah.
And see what's really going on behind the scenes.
Exactly. They give you a framework for analyzing the income account and separating those one-time things from the profits that the company's making regularly. That's how you figure out how much a company can really earn.
Okay, so we're looking for earnings that are growing steadily, not just some temporary spike. What else should we watch out for when we're looking at those income statements?
Well, depreciation and depletion charges. Those can be a bit tricky.
Yeah, those always seem kind of confusing to me. It's basically how companies account for their assets wearing out over time, right?
Right. But the problem is there are all these different accounting rules that allow for different ways to calculate depreciation, so it can be hard to compare companies. And some companies might even try to manipulate those charges to make their earnings look smoother.
Okay, so we need to be extra careful when we're looking at depreciation. What about those balance sheets? They're basically like a snapshot of a company's financial health.
Yeah.
At a specific moment in time, right?
Exactly. And there are definitely some red flags to watch out for there. For example, too much debt. Especially if it's all coming due soon, that can be a big problem if the economy takes a downturn.
Makes sense. Too much debt can really weigh a company down.
Another thing to look for is too much cash just sitting around. It might sound good, but it could mean that the company isn't investing wisely or that they don't have good growth opportunities.
So it's like someone hoarding cash under their mattress. They're not really doing anything productive with it.
Precisely. And then there's goodwill and intangible assets. They can be pretty subjective and might be overvalued.
You're talking about things like brand names and patents, right? It's tough to put an exact number on what they're really worth.
Exactly. So you have to be cautious and look for signs that a company might be exaggerating the value of its intangible assets.
Okay, so we've got to be careful with debt, too much cash, and those tricky intangible assets. What else should we be looking for when we're checking out a balance sheet?
Well, one thing to keep in mind is that too much cash can actually be a warning sign.
Oh, really?
Yeah, it might seem like a good thing at first, but a big pile of cash just sitting there. It could mean the company isn't finding any good investment opportunities, or maybe management's just being too conservative.
Like they're afraid to take risks and grow the business.
Exactly. Think about it. If a company's making more cash than it needs to reinvest in its operations, it should really be giving that extra cash back to the shareholders through dividends or stock buybacks. Otherwise, that cash is just sitting idle, not really earning a decent return.
So a big cash hoard isn't always a good sign. It all depends on the context and how well management is actually using those resources. Now, Graham and Dodd, they also spend a lot of time talking about analyzing the income account.
Oh, absolutely. They really emphasize looking beyond just the basic earnings numbers and digging into the details of how those earnings are actually generated.
Right, we talked about some of those accounting tricks companies might use. But are there any other red flags we should be watching for when we're scrutinizing that income statement?
One thing they point out is the issue of non-recurring items. You know, those one-time events. That can distort the real picture of a company's earnings. Like, for example, if a company sells off a bunch of its assets or gets a big insurance payout, that'll definitely boost earnings for that year.
Right, but those gains, they might not be sustainable. We need to adjust for those one-time events to see how much the company is actually making from its normal day-to-day business.
Precisely. Another area that needs careful attention is inventory valuation.
Inventory. Isn't that just the stuff sitting in the warehouse?
Yes, but how that stuff is valued on the balance sheet, it can really impact companies' reported earnings.
Okay, I'm listening. Tell me more about inventory valuation.
Sure. There are a couple of common methods companies can use. One is called FIFO, which stands for first in, first out. It basically assumes that the oldest inventory gets sold first. The other method is called LIFO, which stands for last in, first out, and it assumes that the newest inventory gets sold first.
So which method is better?
It really depends on the situation. During times of inflation, using LIFO can lead to higher costs of goods sold and lower reported earnings. That's because the newest inventory is usually more expensive.
So a company using LIFO might actually be more profitable than it looks on paper, at least when it comes to cash flow.
Exactly. That's why it's so important to understand which method a company is using and how it might be affecting those reported earnings.
Got it. So we need to dig into the footnotes of those financial statements to see what method they're using and understand how it might be impacting their earnings. What else should we be looking at on the income statement?
Well, Graham and Dodd also talk about the importance of understanding how a company is managing its expenses. Are they keeping costs under control? Are they investing in growth opportunities? Or are they letting expenses get out of hand?
So we're looking for efficiency and smart use of resources. Speaking of smart allocation, Graham and Dodd spend a lot of time on this idea of analyst's investment. What exactly is that?
It's a term they use to describe an investment that meets a higher standard of safety and value. It's not just about finding a bargain. It's about really understanding the business and its long-term potential.
Okay, so it's not just about the numbers. It's about the story behind the numbers.
Exactly. An analyst's investment might be a company with a solid balance sheet, consistent earnings, and a history of treating shareholders well. But for some reason, the market is undervaluing it.
Maybe it's in a boring industry or something.
That's possible. It could also be that. The company is facing some short-term challenges that are kind of hiding its long-term potential. The key is to do your research and figure out if the intrinsic value is actually much higher than the market price.
So it's like finding a hidden treasure at a flea market.
Yeah.
You have to sift through a lot of junk to find that one gem. Now, I know Graham and Dodd, they're big fans of value investing, but they also talk about growth stocks, right?
They do, but they're very cautious about them. They warn against overpaying for growth and emphasize the importance of distinguishing between real growth and just speculation.
Yeah, it's easy to get caught up in the hype, especially when you see a company's stock price going through the roof.
Absolutely. But Graham and Dodd remind us that the market often gets carried away and bids up the prices of growth stocks to levels that just aren't sustainable, even if a company does have strong growth potential. If you pay too much for it, you're setting yourself up for disappointment.
So how do we avoid falling into that trap? How do we find growth at a reasonable price?
That's the million-dollar question. Graham and Dodd suggest a few approaches. One is to look for companies with a proven track record of earnings growth and a sustainable competitive advantage.
So not just a one-hit wonder, but a company that can consistently perform well.
Exactly. Another approach is to focus on companies that are reinvesting their earnings wisely. and generating high returns on invested capital.
So they're not just growing for the sake of growing, they're growing profitably. Now, speaking of growth, Graham and Dodd also discuss the concept of margin of safety. Can you remind us what that is and why it's so important?
Sure. The margin of safety. It's basically a buffer against the unknown. No matter how thorough your analysis, there's always a chance of something unexpected happening. The margin of safety helps to protect you from those unforeseen risks.
So it's like a safety net for investors.
Exactly. Graham and Dodd recommend buying stocks only when the market price is significantly below their estimate of intrinsic value. That difference between the market price and intrinsic value, that's the margin of safety.
The bigger the discount, the bigger the safety net. Makes sense.
Mm-hmm.
You know, Graham and Dodd wrote security analysis almost a century ago, but their ideas are still relevant today. What do you think are the most important lessons investors can learn from this book?
Or I think the core principles of value investing, they're timeless. Thorough research, focus on intrinsic value, margin of safety, and a long-term perspective.
Those principles, they seem pretty universal. They could apply to any market environment.
Exactly. Another key lesson is the importance of thinking for yourself. Don't just follow the crowd. Do your own research and be skeptical of all the Wall Street hype.
So don't blindly trust the so-called experts. Question everything and form your own opinions.
Right. And finally, remember that investing is a marathon, not a sprint. Be patient, be disciplined, and don't get discouraged by short-term ups and downs in the market.
Those are some great takeaways. Now, we've covered a lot of ground here. From analyzing financial statements to understanding market psychology, it's clear why security analysis is considered a classic. It's full of wisdom and practical advice that investors can use to navigate the market and build long-term wealth.
Absolutely. And remember, this deep dive has only scratched the surface of what security analysis has to offer. If you're serious about investing, I highly recommend reading the book yourself and really absorbing the insights of Graham and Dodd.
I couldn't agree more. It's an investment in your financial education. That will pay off for years to come.
Well said. Until next time, keep learning, keep exploring, and keep diving deep into the world of investing.
And as always, thanks for joining us on the deep dive.
One thing that really stands out to me from security analysis is how much Graham and Dodd emphasize the importance of management quality. They really believe that investors need to pay attention to who's actually running the company, because management's decisions, they can make or break a company.
Yeah, that makes sense. Even with the best business model in the world, if you've got bad leadership, it can all fall apart.
Exactly. It's like, you wouldn't invest in a restaurant
Yeah.
if a chef didn't know how to cook. Same thing with companies. You want to invest in companies that are run by people who are capable, honest, and who care about their shareholders.
Okay, so how do we actually assess management quality? What should we be looking for?
Graham and Dodd, they give us some clues. First, look at their track record. Have they been able to consistently deliver strong earnings growth and good returns on invested capital? Second, look at their capital allocation decisions. Are they investing wisely in growth opportunities? Are they giving that extra cash back to shareholders through dividends or buybacks? Or are they wasting money on things that don't really matter, or just trying to build a bigger empire for themselves?
Right. We're looking for a pattern of decisions that are smart, responsible,
and that benefit all the shareholders. Exactly. And third, pay attention to how they communicate with investors. Are they open about the company's performance and the challenges they're facing? Do they treat all shareholders fairly? Or are they always trying to hide things and spin the story? If a company has a history of being good to its shareholders, that's a good sign.
Yeah. It's like those companies that buy back their own shares when the stock price is low. That shows they're really looking out for their shareholders.
Exactly. That's the kind of management team you want to be investing with. Now, another important concept from security analysis is this idea of Mr. Market.
Mr. Market? That sounds interesting.
It is. It's a really clever metaphor that Graham and Dodd use to represent how irrational the stock market can be. They imagine Mr. Market as this guy. He's kind of manic depressive, and he shows up at your door every day, offering to buy or sell stocks at different prices.
So it's like the market is a person.
Yeah, with its own moods and emotions. Sometimes Mr. Market is super happy, and he'll offer you crazy high prices for your stocks. Other times, he's all gloomy, and he'll try to sell you stocks for practically nothing.
I see how that metaphor can be helpful. It reminds us that the market doesn't always reflect what a business is truly worth.
Exactly. The key is, don't let Mr. Market's mood swings control your decisions. Don't get caught up in the hype when he's manic. And don't panic when he's depressed. Remember, you don't have to buy or sell. Just because Mr. Market is knocking at your door.
So we should use Mr. Market to our advantage. Buy low, sell high. But only when it makes sense, based on our own research and analysis.
Exactly. Don't let him control you. One last thing I want to emphasize is Graham and Dodd's belief in diversification.
The old don't put all your eggs in one basket advice.
That's the one. They argue that investors should spread their risk by investing in a bunch of different securities across different industries and asset classes.
Yeah, that makes a lot of sense. It helps to soften the blow if one particular investment doesn't do well.
Right. And diversification. It's not just about reducing risk. It can actually help you increase returns too. By investing in a wide range of assets, you had a better chance of finding those big winners. That can really boost your portfolio.
So diversification is a win-win. It helps us sleep better at night, and it can potentially lead to better returns in the long run.
Exactly. And that's what's so great about security analysis. It gives you this framework for approaching the market in a way that's rational, disciplined, and focused on value.
Well, we've covered a lot of ground today, from analyzing financial statements to understanding how the market works and why people make the decisions they do. It's easy to see why security analysis is considered a classic. It's packed with wisdom and practical advice that investors can use to make smart decisions and build wealth over the long term.
I completely agree. And remember, this deep dive was just a taste of what security analysis has to offer. If you're serious about investing, I highly recommend reading the book yourself and really taking the time to understand Graham and Dodd's ideas.
I second that. It's an investment in your financial knowledge that will keep paying off.
Well said.
Well, that's about all the time we have for today.
It's been a great discussion.
Thanks for joining us for this deep dive into security analysis.
Yeah.
Until next time.
Happy investing.